Hey, sir, before we start, I was actually kind of curious. How do you like balance both studying and like teaching at Donghua? Like, do you have any problems with that? Because I'm gonna start like a five to two job, and I'm
Um,
kind of concerned about that.
well, it's hard to find time to sleep. I'll say that.
Okay.
But no, I don't think it's too bad. I would say don't like my job, Donghua comes first. And I just need to make sure I'm ready for classes and everything like that. Studying isn't that, it's not that hard. I mean, the teachers assign a lot of work, but they don't actually expect people to do it, which is kind of weird. Um, I think it's harder actually to balance trading with any of this stuff because at the beginning, especially, it's like there's an endless amount of things you could learn and rabbit holes you could go down. So for example, we'll talk about something that Constance had asked about today, and that's a whole rabbit hole. I mean, you could spend months, years just studying options, or futures or, anything. It's developing a system where you could trade for 1 hour a day or 2 hours a day. It's doable, but a lot of people don't do it. Like most people in trading, so the statistics are 95% of people who start trading give up. 95%. And of those 95%, most of them give up in the first 3 months. So they'll try for 3 months because 3 months is a pretty good period of time. And after 3 months, they'll feel like they're not really making money or it's too confusing. And that's when people will give up. Or they will blow out their account, which means they will make big bets, and it becomes gambling. And they're just making these big bets and then they lose money and that's it. So we want to make sure we avoid that because it's totally reasonable to trade for an hour a day or less or more or whatever you want. Um, but it comes down to some of the basic principles we talked about last time. So let's kind of go back into um, last time we were looking at some basic rules. Let's kind of review for a moment. So we started with two rules. And the first rule was you never put more than 5% of capital in any single trade. So if you're starting with $100, that means you never put more than 5% of that into a trade, and that's $5, right? So there are two ways we can interpret that rule, and that's a very, very important rule. It's one of the keys to making sure that you don't lose all of your money, that you can be a profitable trader. So let's look at, I don't know if there's any stock you want to look at. Last week, somebody wanted to look at Pinterest, but just let me know if there's any stock that you're actually interested in and we can play with that one.
Could you
Oh my God, what
check
just happened to
Facebook?
Pinterest? Sorry?
Could you check Facebook because they're making a lot of partnership with like all kind of like cult places like churches, synagogue. They're trying to get religion
That's
features
interesting.
into
Sure,
Facebook.
I'll check in a second, but look what happened to Pinterest.
Mm.
On this was, I'm looking at a 1 hour chart. So what does that mean that I'm looking at a 1 hour chart? All of these are different time frames. Can
Like
someone tell
what the
me?
stock were behaving, how the stock were
Like
behaving in the last
each
hours.
candle is 1 hour.
Yeah, that's the way I'd say it. Each one of these candles, red and green, represents 1 hour. So if we're looking at here, you can look at the date range, right? Long, short, date, and price are the four things we kind of look at under this tool over here. So sometimes we want to look at a date range. So let's say we're looking at this range right here. All you do on the computer is you move your arrow and it'll show you how many bars it is. And that's 1 day, 1 hour. Now, let's say we change it to a 4 hour chart. each bar is, 4 hours, that same date range is only now 2 bars, is 1 day. If we change it to a daily chart, that range is 1 bar, it's 1 day. So the bars will automatically, or this date range will automatically adjust, right? So if we're looking at 1 day, let's go back to the 1 hour chart. What happened here is very interesting because on here, when trading closed on, it is yesterday, July, oh no, this is a little while ago, on July 29th. At the end of the day, trading stopped at approximately, 71.56 or so, a little higher. 71.80. And the next day, trading began at 59. I mean, if you were watching this, you could have made a killing. But also, this would be, this looks like a good chart because of another rule called the 50% rule. And the 50% rule is really basic. So we haven't talked about this, fib retracement, and that's not something I was going to talk too much about today, but it's super important. My plan was next week, we're going to spend pretty much the whole class on fib retracement. But if we draw a fib line, just so you see what it looks like, generally fib retracement would look something like this. And I'll explain it to you in more detail next week. All of these numbers are Fibonacci numbers. I'll also give you some videos to watch, but Fibonacci numbers are really, really important in trading. But the basic 50% rule would say you can draw these lines and just, if it's 50%, there's a very good chance the price is going to go back up to here. Like a very good chance. So if I was interested in taking this bet that the price is going to go back up, let's go back to a long, let's say I wanted to long, right now the price is 56.49. Now I always want this green number to be at least 2. Never take a trade if the green number is less than 2. What does this green number mean?
It's times.
Yes, times or multiplied. So if you, let's say the price right now is, excuse me, 55. Let me just make it easier for math. You can go into this gear icon, You can go into this gear icon and you can go to change the entry price. Let's just make it $55, just to make the math easier. Okay, so now let's say we buy in at 50, oh no, that's a little low. Let's make it 56. Okay, let's say we buy in at $56. Now I said before, the number one rule is never risk more than 5% of your trading capital. So, but the problem is you can't bet $5. How do you bet $5? The price is $56. So you can't just bet $5 on this. Now, on some websites like Robinhood, you can. They will let you buy what's called a fractional share. So you're buying a part of a share. And some places you can do that. And if you can, cool. But how would you bet on this if you can only risk 5%, so you can only risk $5, but the price is more expensive? Anybody remember how you would do that?
You buy, let's say the price is 56 now, so you can buy, you spend $56 and you can set what's it called, like the
stop loss?
Stop loss at 51, so you're only risking $5.
Exactly. Great answer. So that's the other way to do it. Either you're looking for cheap stocks, or you're buying a more expensive stock, but you're setting your stop loss. So let's set this stop loss for 51, entry, risk price, stop level. Let's set the stop level for 51. Ticks, by the way, a tick in stock is one. You see how this is laid out in a grid, all of these squares, and it's very light, but if you can see it, like here you see the price is 67.50, 65, 62.50. If we extend this out, each of these is called one tick. So right now a tick is 50 cents for 64.50, 65, 65.50, 66, whatever they are. Sometimes on Facebook, because Facebook is more expensive, a tick might be $1, it might be $5, but it's kind of one level. So let's readjust that, make our stop loss 51. Now, that looks pretty good, right? 51 is actually pretty far down. If we're betting that it's going to go to that 50%, we're at 2.06. This is a good trade. I will actually even think about taking this trade. But there's another rule we need to know. So the first rule was 5% rule. And there's two ways you can risk 5%. Now this is actually critical. You can't ignore this rule. You can't just say sometimes I'll risk 10. Because the second rule, which is just as important, is you need to establish a 66% edge. Your edge is your trading plan. And you cannot trade successfully without a plan. So like, what would the plan be? If my plan is, let's say, one, I need to find a 2-to-1 trade at least. Number two, don't risk more than 5% on any single trade. So look, you could take 10 trades today and risk 5% on each one. I'm not saying don't risk more than 5% a day. I'm saying don't risk more than 5% per trade. But we need to know number 3, 4, 5. We need to have indications of whether or not our plan is going to be successful. And so for number 3, I think for the rule would be use support and resistance levels. That's kind of where we are right now. And so we're going to continue with that today. And today we'll get to what we've already done is what we'd call static, or I guess is usually called horizontal support and resistance. Today, we'll learn dynamic support and resistance. Then last time, we talked about find a W or an M. And is it confirmed? Let's review to make sure that. Once we have these things, next week we'll get to check the Fibonacci levels, and then you're ready to make the trade. Now, we said already last week, so here's I think, sort of a basic plan at the beginning so that you don't blow out your account and lose all your money. So we have, this looks like a really nice gap. And there's a whole theory about gaps, but we're still looking for M's and W's. We're still looking at support and resistance. So from last week, what was the homework last week? I said choose, last week we did the trend lines, we did M's and W's, and we did support and resistance. And I said, draw support and resistance lines on the weekly, daily, and 4-hour. Trend lines, find at least one confirmed M and one confirmed W. Any of you guys do that?
Yes, I did it.
Cool. Do you want to share your screen and show us?
Sure.
Yeah.
I actually chose Dow Jones because you mentioned last time.
Sure.
So I only did I did mostly on weeklies by each year, and each weekly are whether there is whether there is a transition of going up and down.
Good.
And I here find and I also drew this trend line here and here and here, and I found the M, and I found the spot that, is it M? No, it's not. No, it's not the right M. Anyway, I found another one here, and these. I was actually not sure if I had to draw the trend line on here or this one up here. And I also was confused about the bottom one here and here.
Okay.
And I think it is this one.
Yeah, sorry.
No, you go.
The bottom trend line looks good.
This one?
Yes.
What about what about the top?
The top trend line? Yeah, I mean, that's okay. You have it from a pivot point. We don't call them transitions, we call them pivots. So you have it from that pivot point, the high of that pivot point that looks like it's in. The problem with the top trend line is look at when it starts. I mean, the bottom trend line too. You're talking about a trend line that literally starts in like 2008. And now it's 2021. So I don't know if that's valid anymore because your time frame is so big. You know, you're talking about looking at the trend of the US economy over like 12 years. But a lot has happened in 12 years.
Okay.
So I'm not sure of the time frame. Two other comments. One, you're going to hate me for this, but I changed my mind and now I'm not using rays, I'm using lines. And the reason is if you use lines, you can go back in time and the line is there forever on both sides. If you use rays, it's good because you know when that line started, but you can't go back in time. For this, for weekly, I think it's fine that you used rays. For daily, you might want to change those to lines. I went back to my chart and I changed them all to lines. But that's great. It's great that you labeled them on the side, weekly and daily with the numbers. That's really good. It looks very clean. It's great that you use different colors and that you're kind of making the chart your own. The lines look good. Let's talk for a minute about these M's and W's.
I found in daily.
That's a nice W. Go back. That little W, yes, that is a very nice W. And I see you got the confirmation point of the W with that white line, and you circled the confirmation point. That's great. So that is what a W should look like, right? The second, the A, B, C, D, the D point, which is the second V, is a little bit higher than the first V.
Yeah.
And we have the circle where it confirms. That would be the point where you take your trade. Now, here's what's so interesting about trading. If you bought the Dow Jones, the Dow Jones is a basket of stocks, but you can certainly buy it as a mutual fund. If you bought it at that price, and that's obviously $27,000, so you're not really buying it, it represents the US economy. But if you bought it at that price, what would have happened? Well, the price would have gone up, right? It would have gone up, and then it would have gone down or sideways a tiny bit, and then it would have gone up again. Then it would have dropped back down. But where did it drop down to? What level?
I didn't
Constance.
understand the question.
Like the start of the W? Like
Yes, so now
approximate point?
if you bought it at the circle, can you
Uh-huh.
zoom in a little bit? Just make it bigger.
Yeah.
Yes, like that. Little bigger. And we're gone. Okay. Okay, if you bought it at the W, at the circle, what would have happened? So the price would have gone up a little, right? And then it would have gone down a little bit. And that is what we call the fake out. Because for beginner traders, they're going to get faked out. Actually, this is a great trade. It's going up. But beginner traders are going to get faked out. These are people who don't have a stop loss. So people who don't study trading and just watch videos or something and they don't have a stop loss, they're just watching the price and it makes people very anxious. So maybe they watched a video about W's and the price goes up a little bit and they're like, yes, it worked. And then the price goes down and they're like, oh my God, I just made a little bit of money. I don't want to lose my money. Okay, I'll get out. That's what the big money wants. You know, so they just faked a lot of people out. Now they're ready because they want to buy this, but they want the price to go down a little bit. So now they could buy it and they're buying it at the top of that, the first V, right? It's the price has gone back down. So go up from the circle a little bit, down next to the next pivot low. Yes. So you see that level is already a level that we've seen. That's the exact top of the W, right? That's exactly the same top of the W. So now this is where like the big money banks and stuff are going to buy back in. And now you see the price goes way up. It goes all the way up and then it pivots all the way down and it shoots down to there. Look at that level. That's an important level. No, back to the previous pivot. Yes, there. That's an important level. That's a weekly level, right? You already marked that, or daily. I don't know if blue is for you. Is blue weekly or daily?
Weekly.
So weekly levels are very powerful. The bigger the time frame, the more powerful. So a weekly level is huge, and prices tend to respect these levels. So if you, like you did, you marked out your chart with these support and resistance levels, you were ready. You knew that was an important level. And when price came to that level, instead of panicking and just selling, what you would do is look at your indicators, and we'll start looking at indicators today to try to figure out, okay, this is an important level. Is price going to respect it and bounce off, which is what happened, or is price going to go through it? And now what was the floor has become the ceiling. Is that going to be a floor or a ceiling? That's always the question with these daily and weekly levels. Are they floors or are they ceilings? And you can see it's a floor, right? Because it hit the floor, it bounced all the way back up, go back up to the next pivot. Good. And then it almost hit the next level and then it went back down. Where did it go down to? The same floor, that same weekly level, that blue line. And then it went down a little bit below, but nope, went back up because it's still the floor. What we're trying to identify is these weekly and daily lines, are they the floors or are they the ceilings? That's the first big part of our ability to trade. You can't trade unless you have these levels, these floors and ceilings. And that's the first big mistake people make, is they hear something about, a good example is Like Constance said, she heard something about Facebook, and we'll check Facebook in a minute. That is a fundamental piece of news. Oh my God, Facebook is starting their own money. Facebook is getting involved with churches, Facebook, and then people get in. But the problem is people don't have an idea of the floor or the ceiling, so you can't just get in. You have to know where you're getting in. Are you getting in near a floor or a ceiling? You know, and another way to say this, the way that you would see, like if you watched the news or you watched trading videos, people would say, is that priced in? Priced in means the price of Facebook currently might include already the news that they're working with religious organizations. The price might be high because everybody knows they're doing that, like the big players, and so the price is high. Sometimes things are priced in. If it's not priced in, then that could be very good fundamental news. But you know, we are the retail people. We are the dumb money. So there's a lot of smart money that has connections out there that we don't have, that is going to know things before we know them. But one thing we have that is in our favor is this program, TradingView. It's the same program they're using on Wall Street. Everybody's using this. So our daily and weekly levels are the same as, you know, the CEO of a big Wall Street hedge fund. It doesn't matter. They don't have better levels than us. We all have the same levels. And we can all, then it just comes down to analyzing it. So, okay, that's a very nice W if you bought it at the circle. If you had a good take profit, you would have made money, because at that take profit, at that first pivot, you would have sold at least half of it. Generally, the rule for beginners is sell half on a double. So when your profit goes up to 2, take out half. That means if you put, probably you wouldn't sell there. I think you'd probably sell at the next high. Yes. I think when it got there, you would sell half. So if you put in $100, now you would sell half. So you would take out your 100 and you'd still have 100 in, and now you're playing with house money. That's what we want. So, okay, let's see your next W.
Sir, I have a question. Every
Yes.
time, what's in between those gaps? Like, what were the theories you were talking about? Like, fundamentally,
okay.
people don't know what's, like, what created it, or
So,
it's the after-hour trading?
yes, it's after hour trading. And we can talk about gap theory a little more next time, because today we will talk about futures. Gap theory, what you need to know most is gaps want to be filled. Gaps get filled 99% of the time. It's actually not 99, it's like 98 or something, but that's what I was taught. They get filled. Now, what does that mean? They get filled? That means, like it or not, someday price is going down to that level. Right now, the American economy is so high. Look, the Dow Jones is so high. Gaps get filled. So there's a really good chance that someday the Dow Jones is going to go back down to that level it was at in 2020. That looks like it's 2020. Yeah. And that's not that long ago.
What do you mean
and gap means that where Minsu's cursor is right now, the black space between where price jumps. Now, why would price jump like that? Where on one day price closed at 28,301, and the next day it opened at it looks like 29,000. I mean, it's like a $5,000 jump in one day. How did that happen? Why isn't that on the chart?
So they're adding values or taking out values of the stock?
Sure. Well, and as you just said, this is after hours trading, which and this is something that's not fair about the system, we little people can't do it. Only the big banks and the big players are allowed to trade when the stock market is closed. They can, but we can't. And what happens is, generally, there's some fundamental news that came out. So maybe we found out that, that night, the Senate in America, the Congress, passed a $1 trillion bill And we don't know yet, but the
Ah.
people in the Senate know because they passed it. And the bankers, they have connections in the government. And so they called up the bankers and said, hey guys, we just passed this bill. And so the banker, I mean, that's the kind of thing that happens. It's all under the table, hush, hush, quiet. And the average people don't know. Now, what's dangerous is when it happens the other way, when there's a gap down, because that means it might kill your stop loss. What if you had a stop loss that was really tight at $5 or $10, and the next day you wake up and the price started here?
Mhm.
That can happen. You know, so you do have to be careful. Sometimes people will set multiple stop losses, or you just pay attention. You know, but the problem is sometimes a trader will set something, set it and forget it. You know, they'll put on a stop loss and a take profit and check again in 5 days. And the problem is with trading, you don't need to spend a lot of time per day, but you kind of need to look at it. And if it makes you anxious to look at it, you're trading too much money or you're trading on too fast of a time frame. Instead of using a daily time frame, you should be using well, daily shouldn't make you stressed out. But if you're using a 5-minute time frame and you're feeling anxious, start using a 1 hour. Okay,
Can't
Minty, your
you
second.
so
Yep.
can't you set alarms like on your charts?
Yes,
about the-
absolutely. Minsu, go to the midpoint of that W. Now, I have to say, this W I don't like as much. It's good. It's still technically correct. I don't like it as much because the first pivot point, the beginning of the first V, is low. Right now, the middle point is higher than the A point. Go to the A. Yes. You see, I prefer in a W that the A comes down, then it goes up, but the C point should not be above the A point. You know, it should be A, B, C, D, E. You know, I like a higher A point, but it's still technically correct. And if you took this trade, you would have made money. This was the W did confirm at that circle. Now it confirmed before that circle though. There, that's where it confirmed. You know, that's where you would have bought in. Now, if you miss that buy, you had a second chance where you drew the circle. You know, but that's the, get out of here, fly, I hate you. That's where you, that circle or the previous one is where you would have bought. But you see, here's another example of what happened. If you bought where the cursor is right now at that W, at that circle, the price would have gone up and then it would go back down because it scares people. You know, I was taught the market, the stock market, is the most effective way in the world to move money from people who are scared to people who are confident. That's what it is. That's what it does. You know, they also say scared money doesn't make money. And it's true. Because if you got scared when that price started to go down, you'd be like, oh my God, I got to get out. You'd get out at the same price you got in. So fine, you didn't lose money, but you didn't make anything. But that's because the market was faking you out. If you stayed in at that point, then the price would have skyrocketed up and you would have made a ton of money. Okay, good. Those are good W's. Any other ones? Or an M?
That's it.
Okay.
That's it.
Yeah, I don't see any beautiful M's, but that's not too surprising because the price keeps going up. I see an M actually. I see a couple of them. But I'll check it. I'll show you on my chart. Okay, good. Let's close that. Misha, you said you did it also?
Yeah, but I didn't do the W's and M's. I just did the weekly
okay.
and
Do you want to share your screen and show us?
sure, I did it for AMC. Let's see.
AMC. So you're a DGen.
It was like a big thing a while ago.
I know all about it. Do you know the term DGen?
I do not know.
Oh, like I'm a DGen. DGen is very modern slang for degenerate trader. A degenerate trader is somebody who will trade these like ridiculous, like these, just not a safe trade. And I enter trades sometimes that are just not safe at all. But I have my risk. I'm willing to risk 5%, and that's it. It depends what your risk tolerance is. Everybody has a different level of risk. But I never risk more than 5%. That's actually not true. I never should risk more than 5%. I break my own rules plenty of times.
I had the lines. Where did they go?
It looks like you're on the monthly. Go to the daily or something. And go to the bottom right and press auto.
Yeah. There we go.
Okay.
I didn't really mark them though.
Yeah, so you'd want to label them. I like the color.
Yeah, I didn't do it as well as Mitsu, but
it's good. It gives us some levels. Have they respected those? That one at the top is definitely being respected. I mean, that's a real ceiling. It keeps trying to break through that ceiling and it can't.
I didn't really quite understand, not the point, but isn't it pretty much just getting it to like this average? Isn't that what we're sort of looking at?
It's, prices are weird. The stock market is weird. Looking at charts is weird. Imagine that this is something alive. It's not just numbers. It's sort of alive. And it's got floors and it's got ceilings and it's trying to climb up. That's its goal. But sometimes it falls down. And sometimes when it falls down, it hits the floor and it climbs back up. And sometimes it falls down really hard and the floor breaks and it falls to the next floor and then it has to climb back up. It's kind of like that. So this 36.01 level, that was a floor. Price went way through that all the way up to 61. Then it went down. It broke the floor a little bit. It went to like $32. Then it went back up to around $48. Right now, though, it looks to me like that has become a ceiling. That is now the next one up, the next line up, 36.01. The next blue line.
This one.
Yeah, that is now a ceiling. Price is now trying to break through that. And what that means is that's our key level. That's our important level. We need to figure out, is your bet that price is going to fall down? Now, if price falls down, where do you think it might go? 1988. That's where it might go. And that's the point of having these lines, is that we can already have a prediction. If price falls down, there's a pretty good chance it's going to fall to your next support and resistance level. If price goes up, where is it going to go? Now, you'd probably want more lines. You want monthly, weekly, daily, 4 hour, but the point is, if you think price is going to go up, you don't just bet on red. You don't just bet that it's going to go up or bet on green. What you do is you have a very clear idea of where is it going to go next. And then you can figure out what's my stop loss and what's my take profit.
So do I do that by essentially making like as many lines as possible via like monthly and weekly, or
yeah,
just
monthly, weekly, and daily?
I get it.
And not as many as possible. It's more of an art than a science, but you definitely want all of these big empty spaces in price to have some lines in the middle where you think price might go there.
Can you explain, please, the wicks of the candles? Like if we, take a look at the candles.
Sure.
I know that this is the real body, right? So, for example, for this one, this is the open price and this is the close price.
So right now we're looking at a 1 day candle, right?
Are they?
Yeah, they are. You can see it on the title. It says AMC Entertainment Holdings Incorporated 1D.
Yeah. Right.
So that green candle on that day, so let's say trading was 9 o'clock to 4:30, or maybe it's 9 to 4. At 9 o'clock in the morning, the price opened up at that candle body open right there. So at about $40.79.
Mm-hmm.
Throughout the day, Of course, the price went up and down as people bought and sold throughout the day. The lowest price that it hit the whole day was the bottom of that tail.
Ah, okay.
Now, it didn't stay there, but that was the lowest price it hit that day. And the top of the wick, that was the highest price it hit that whole day, but it didn't stay there. At the end of the day, at 4 o'clock, what was the closing price? Yes, the candle body close. Now, for a red candle, we start at the top because it went down. So there, the next day, the price opened a little bit higher, right? So there was some good sentiment, the price, and throughout the day, the price went up, it went down. The highest price of that whole day was the top of that wick, even though it's a small wick, right? It's a little higher.
Yeah, this.
Yeah, that was the highest price of the whole day. Then the lowest price of the whole day was the bottom of that tail, and then it closed right at the candle body close. And the next day, it gapped, right? The next day, the price fell a little bit. And the day after, it fell even more.
So between these two, there's a gap because I assume like the market closed, right?
The market closed at 4 o'clock, but the bankers didn't.
Right.
The hedge funds, the mutual funds, the bankers, you know, they have stock, right? So they're like, if I'm a multimillionaire, I could still call Constance and say, hey, Constance, I want to buy 10,000 shares of your AMC stock. And she works at a bank and it's 10 o'clock at night. And she says, okay. I mean, it's a free economy. She could sell me her stock and it's whatever, you know, we trade back and forth and all of that happens throughout the night. Not even to mention people in other countries. You know, like much later when we talk about this, we'll get into things called kill zones. Right now, we're talking about the United States kill zone. You know, but there's the Tokyo kill zone, the London kill zone. There's all of these different places where the price changes a lot when Japan wakes up. The price changes when England wakes up. The price changes when America wakes up. I mean, now the price changes when China wakes up. Like, everybody's involved in these markets.
Sorry, I just don't understand why the candle on the left is colored as well, red.
Candle on the left. Can you be more specific?
The one where like Misha has his mouth on.
Yeah.
Like the one in between on July 12th, approximately, on
yes,
the right.
It's good to use
on
dates. So July 12th, around there.
Yeah, on the left, there is this green candle in the middle and both are red.
Yeah.
So why the one on the right is reddish? If it went up? No, the one
Okay,
up.
well, let's look at the red candle before the green.
Yeah. No, Misha,
Yes, that
exactly.
one. So what happened on that day, Constance? What was the opening price at 9 o'clock in the morning, approximately?
45.13.
Nope. That was the closing price. The opening price.
The opening is up or down?
Okay. Because it's red. 47. Yes, a red candle opens at the top because the price went down that day. Okay. Or it doesn't have to be that day. It could be that 4 hours or that 2 hours or that 1 hour, whatever the candle is. It could be that month. But right now we're looking at daily candles. So the candle starts for a red candle. It opened at that price around 47.84. And then throughout the day, the price went up and went down. And what price did the price close that day at 4 p.m.?
44.96.
Good. Now, the next day at 9 o'clock in the morning, what was the opening price?
Oh, 40?
Yes, because that's a green candle. So it starts at low and it went up that day and it ends high.
Okay, understood.
And then the next day, the price started actually higher. The price started at 48.25, but then throughout the day it went down and it closed at around 46.28.
Okay. Thank you.
Okay, cool. Good, thanks. So, Constance, did you have any chart?
Not.
Okay.
Can you explain the open interest thing? Because
Sure.
I looked a lot into that and it seems.
Sure.
Like
So
I have
let's
questions.
jump ahead a little bit. We'll come back to what I want to do today, which is what we're going to do today. I just want to have a couple more rules. I'm then going to show you today. It's 11 o'clock. Okay. I'm going to show you these three things: SMA, EMA, and MACD, because that's going to be our next important thing, is the dynamic SNR levels. And I'd like you then to do that for homework. And then the following week, we'll do fib levels, Fibonacci. So let's just go through these rules and then we'll do the options and futures. Number one, never risk more than 5% on any trade. Number two, always establish your edge, which means be able to come back and play tomorrow. That's called the rule of capital preservation. Don't lose all your money. Trading should be boring. If you're really, really excited, that's not good. You know, trading it produces dopamine. We need to be careful. We're trying to keep our anxiety low. The most important thing is location. That's the most important thing. So these floors and these ceilings, this is location. That's what we want first. Before anything else, we want to know, where is the price relative to the weekly levels? Where's the price relative to the daily levels? Is it close to a floor? I mean, that's what a lot of beginner traders don't realize. They look at the price of Facebook, but they don't think, when is that a floor? Maybe for the last year, the price keeps bouncing off that level. Well, then they have to know that. Or maybe that's a ceiling and the price keeps going up to the ceiling and falling down and up and falling down and up. I mean, they have to know. Two other rules. Another bus in 10 minutes. Another bus in 10 minutes. Let's say you're waiting for the bus and it's a bus that comes every 10 minutes and you miss the bus. Would you start running on the street after the bus? Probably not, because that's dangerous. You would wait for the next bus. Trading is the same way. Prices are always going up and down. There's always a trade you can find. Never chase the trade. If you feel like, oh my God, I should have gotten in, now it's going up, another bus in 10 minutes. Don't chase trades. And this final one, when in doubt, pull out. So you can see my screen?
Yeah.
Okay, so when in doubt, pull out means, let's say I'm looking here at this 1 hour chart. And I'm like, okay, let me even zoom in closer. It's 30-minute chart. And I'm like, oh my God, what's going to happen here? I need to know what's going to happen with this price. Should I buy it? I don't know. When in doubt, pull out means go to a bigger time. Let's go to 4 hour. And we can see on the 4 hour, now I can see, is this a good price? Well, it did go lower than that back in May, but yeah, it's a pretty good price. This is close to the low. What about pull out even more? Let's go to the daily chart. Now I can see, is this such a good price? I don't know. Look at the pro. My God, this is a good price, where the price is all the way down here. You know, and then it went, oh my God, had this huge move up. So in fact, what on a 30-minute time frame, what looked like an amazing deal, you know, like, oh my God, it went all the way up and it dropped down. This is a great deal. We have to buy it here. If you pull out, you look at the daily, you realize, like, where is this really? That's maybe not a great deal. You know, and when you're in doubt, you have to look at the bigger chart. When in doubt, pull out. Okay, Constance, where'd you go? I want to show you the options thing. Let me open it at least. There you are. Okay, we're going to have to explain a few concepts for me to explain options. And I would recommend probably just going to either, if you're really interested in this, you could take an options course. Oh, that's not there. That's weird. So, okay, let's start with the Greeks. Okay, so first of all, what is an option? We need to start there. Now, here's where you find the prices. This is cboe.com. This is the Chicago Board of Options Exchange. It's very old, you know, I mean, for America, it's 200 years old or something. It's quite old, you know. And where you would go to this quotes dashboard. They have it on the top, the quotes dashboard under data. Data quotes dashboard. Now, let's say we wanted to look at Facebook. Is that, I think Facebook is FB, if I remember right? Yeah. So Facebook's price is doing pretty well. So you type in the ticker symbol. That's like the letters, you know, FB or PIN or APPL or things like that. And what we should get is Facebook's options, okay? Options. Okay, here we are. This is the kind of stuff we want. Let's understand what this means. This is, I think, what Constance is talking about. So let's make sure we understand what are options first. Let me unshare for a minute so we can just talk about this. So this is the way it was explained to me. Think about the Kellogg's Corn Company. Have you guys ever eaten Kellogg's cereal? They make breakfast cereal, like cornflakes. Now, Kellogg's is an old company, a couple hundred years old. And Kellogg's needs corn, right? They can't make their cornflakes without corn. So they need corn. And they obviously need to buy it from the farmers. Now, the problem about buying corn, because they need a lot of it. They need, you know, thousands and thousands of pounds of corn, bushels of corn. The problem with that is when the harvest is good, so in the summer, I mean, I don't know harvest times, there's a lot of corn and the price is low because there's so much supply. But then in the winter, there's less corn. And so the price goes up, right? Supply and demand. When there's more, the price is low. When there's less, the price is high. So the price of corn is going up and down all year. That's not great for Kellogg. They're trying to make an annual plan for their budget and all that. It's not good that the price is going up and down, right? So they want, let's say that Misha has a farm. And we, Minsu and Constance and me, we're the CEOs, we're the directors of Kellogg's. So we want to make a deal with Misha. We say, listen, Misha, we know that the price is going up and down all year. How about this? Give us a good price. So I don't want to pay $100 in the winter and $5 in the summer. Let's just make it $25 every month. That's called a future contract because it's a contract for the future. And that's how this all started. This all started in Chicago. Now, it started in Chicago because Chicago is a center of a lot of railroads in America, especially in, you know, the 1800s. It was one of these transportation hubs where big trains carrying steel and corn and oil and cotton and chocolate and whatever, all of these, it was almost all food. So not really steel, but like food, cotton, stuff like that. It was all going through Chicago. So a lot of these deals were being made in Chicago. Now there's a problem with futures. You can trade futures now. That's a totally legitimate. Lots of people trade futures, but futures are quite dangerous. So let's say that we made this deal with Misha. We're going to buy corn from him, $25 a month. Now, right now it is August. What happens when there's a bad drought? There's no rain. And in October, the price of corn has actually gone up a huge amount. Now, Misha doesn't want to keep our future contract anymore. It's not a good deal anymore. So he wants to break it, right? Constance, what?
Can he revoke the contract under the act of God thing or not?
Well, I mean, that's getting, the force majeure. Sure, he could, but the bigger point is we are screwed. I mean, it doesn't matter. Yeah, well, it doesn't matter what his excuse is. So he calls us up and he says, "Hey, David, Constance, Minsu, I'm really sorry. There was an act of God. There was no rain for a whole month, and now I can't sell you the corn." I don't care what his reason is. We need the corn. So this was the problem in the old days, is the farmer could break the contract. Now, can we sue him? Sure. Does that help us make cornflakes? No. So sure, we can sue him, but it's going to take months to go to court. We need that corn in October to make our cornflakes, or else our stock price is going to go down. Our investors are going to lose faith. So we need a guarantee. And the problem of futures contracts is there was no guarantee. And so there was something that was created called I forget the name right now. It's Trading Corporation. Forget the name right now, but it was created by the government. And it's a government-created trading organization that will guarantee that we get our corn. That made futures a lot more safe. That happened in if you look at see if I can find it. Okay, so the first one was organized in 1875. And then the CME, originally it was the CME, the Chicago Mercantile Exchange, mercantile like market. And now they've changed it to the CBOE. A clearing corporation, that's what it's called. So the government created a clearing corporation, clearing house, and they stand in the middle of every trade, which means they guarantee that Misha will get his money, even if we go bankrupt, and we will get our corn, even if Misha breaks the contract. This is the only way it works. So now we have these clearing corporations.
So options is specific to the US?
No, lots of countries have options. It just kind of started in the US.
All right.
Okay, so those are called futures. Now, in the middle of this, 1800s, early 1900s, the market is being developed. They created this idea of options. So both options and futures are kinds of contracts that are called derivative. And you'll see this word a lot, derivative. Now, if you're trading corn, so Misha produces corn and we are buying and selling corn. We are buying and selling the actual corn. You can actually buy and sell corn, right? We could go to the contracts. Let's go back to Trading View and let's find corn. Now here's corn futures, cash settled corn. Okay. This is the price of corn. Let's see, what's the price? $97 a bushel, however much corn this is. I don't know how much 1 unit of corn is. Corn seems very expensive right now, like all-time expensive. What the hell's going on with corn? Anyway, so this is like the price of corn, and you can buy and sell corn, sure. But it might be easier because, look, you don't want to get 1,000 pounds of corn delivered to your house, and you want to trade gold, but you don't want to get a pound of gold And you want to trade cotton, but you don't want to get 1,000 pounds of cotton delivered to your house. So instead, that's called the underlying asset, the real thing. The underlying asset is the real thing, the corn, the cotton, the gold, the coffee. Now, I want to trade coffee prices, but I don't want to really get coffee. So I'm not going to trade the underlying asset. I'm going to trade the derivative. It derives from the underlying asset. I'm going to trade coffee futures, where I'm not really trading coffee. Now, futures were originally meant for foods and products like cotton, real things that are grown in the earth or mined from the earth. That's what they were meant for. But then in the early 1900s, some people got an idea. What about the price of stock? So let's say Facebook. Well, I can't really have a futures contract for Facebook because you don't grow it. There's no harvest. You don't harvest Facebook. But the price still goes up and down just like corn. So people created something new called an options contract. So options came after futures, but it's a similar idea. An options contract is a futures contract for stock. Generally, futures contracts are for things that grow in the earth or are produced from the earth. Carrots, vegetables, fruits, cotton. When we talk about having this kind of future contract, but we talk about for a stock, that's called an option. Now, if you want to buy Facebook stock, you could buy 1 share or 2 shares of Facebook stock. If you buy 1 option of any stock, 1 option equals 100 shares as a rule, always. So let's say I want to buy 1 option contract. That's what we call it. You're not buying an option, you're buying a contract. Now, when we talked about corn with Misha, and we're the Kellogg's company, we had a contract with Misha. And the contract said every month he's going to give us corn, like 1,000 pounds of corn, and every month we'll give him money at the price of $25 per pound or whatever. We had a contract. It's the same idea. You have a contract, and the contract is not with Facebook. It's with another person. So let's say that I want to buy 100 shares of Facebook stock, and I want to buy them from Constance. Now, if you actually sell me the stock, we have to do some procedures, right? You can't just like hand it to me. It's stock. It belongs to you. You need to sign some documents. You need to, transfer the ownership to me. So what if I said this, Constance, don't give me the stock. You keep it. I don't want to go through this headache. But let's pretend the stock belongs to me. If the price goes up, I make money. If the price goes down, I lose money. So what I'm doing is I'm betting. Options is gambling. It's the beginning of this. It doesn't mean it's not educated gambling, but I'm betting that the price will go up or down without buying the underlying thing.
Oh, so that's exactly what happened in 2008. They were
yes, they were betting. Nobody was buying and selling these houses.
That's why
they were just betting the price was going to go up and down. And here's something that's very interesting. I was going to wait to show you this, but let me show you now because it's kind of mind-blowing, to be honest. Let's see here.
David, I have a question.
Yes.
You mentioned about the corns, and then they have a price for corn cash settled, and then another one for corn future. Is there so those two are different, but is there one that combines these all two together?
I mean,
Guys.
what there are companies that buy and sell corn, and they will sell stock in their company. So there's corn futures, that's a thing. There's corn options, that's a thing. And there's corn. Those are three separate things. But then there might also be a company called the Constance Corn Company. And what Constance does is she buys corn from all different people around the world, and she sells corn and she sells stock in her public company for $5 a share. Now, that's not the price of corn. That's the price of Constance's stock. But if corn goes up, so does her company's value. So there's lots of ways. I mean, a good example was, you looked at the Dow Jones before. If we're looking at the Dow Jones Industrial Average, if you actually wanted to buy a share, nobody's buying $35,000 shares of the Dow Jones. But you could definitely buy, I don't know what it would be called. Let's check. Dow Jones Mutual Fund. Every single one of these.
Of stocks?
Then you can buy the Vanguard Total Stock Market Index. That's the Dow Jones. You can buy the Goldman Sachs Market Index, the MSCI Market Index, the JP Morgan Chase Market Index, the Diamond Trust Series. Every single one of these is the Dow Jones. Let's look at Vanguard Total Stock Market. Let's see what that is. It's a very famous one, Vanguard. Okay, the total stock market. I mean, look at how many Vanguard has. So if you want to invest in an area like real estate, but you don't know how, you don't know what are you going to buy a building? I mean, you can't buy a building. You can buy Vanguard. This is $100 for one share, and they invest in nothing but real estate. That's what they do. In that fund, you could information tech, growth, high dividend. Russell 2000 means smaller companies in America. Long-term treasuries, the top 1,000 small companies in America. Healthcare, value, energy, financials, consumer staples, that's like food. Consumer discretionary.
For like you're kind of like lending them money for projects.
Well, you're buying one share of their basket. Okay. So if you look at their, I mean, they have so many of them. Let's go back to the total stock market. This should be pretty much the same chart as the Dow Jones, except to buy one share now will cost you $228. There's lots of these. If you want to spend $5, you can find another one. You want to spend $10, you can find another one. There's mutual funds for every area of the market for every price range. But let's go back to Facebook. Let's say we want to buy Facebook. The price of Facebook is $358 right now. I don't want to spend $358. And I think the price of Facebook, like Constance said, when in doubt, pull out. So let's look at a weekly chart of Facebook. We're pretty much at the all-time high ever in the history of the stock. What if I think the stock is going to fall? I think the price is going to go back down here to this level. Let's say I think the price will go back down to 135.91. I want to bet that it'll go down to this level. Now, I don't want to buy Facebook and hold it. I want to bet on Facebook. So I'm not actually buying the stock, Facebook. I'm just betting on the price. That's called a derivative. Now, how important are derivatives? Here's the picture I was going to show you before. This is a visualization of the world's money. This is from 2017, so it's a little old. Okay? These are the squares. So one square, this is like all of cryptocurrency. Let me see if I can make this bigger. Okay. Here are the biggest companies in the world. So what does one square represent? Okay. Each square is $100 billion. One square is 100 billion US dollars. Silver is 100 billion US dollars, the silver market. Cryptocurrency. Okay, Bitcoin is 100 billion. The rest is 45 billion. Ethereum is a tiny little part. Let's look at the biggest companies in the world. Facebook, 1, 2, 3, 4, 5, $500 billion and a little bit. Apple, you know, with $800 billion. This is Amazon. Amazon's probably gotten bigger now. Google, Alphabet, Microsoft, Berkshire Hathaway. The 50 richest people in the world together are this much money.
Yeah, but they're worth like shares and stock, and it's not
everything.
Yeah, but it's
their total value.
Yeah, but it's air value. Like it's not like.
Well, I mean, like you said, their value changes on different days if the stock market goes up or down, because most of their money isn't in cash. Most of their money is in the markets. But, you know, approximately, this is how much money the richest people in the world have. This is the GDP of California, a little bigger. The Fed's balance sheet, that's US government, is 3.5 trillion. How about all the currency in the world? USA has this many billions, this many hundreds of billions. The rest of the world, the Eurozone, China, you know, all of this has changed a little bit in the last few years. What about gold? This is how much billions there are in gold, okay? Now, next is stock markets. Here's the stock markets. So the entire stock markets, here's the US. It's bigger than the whole US economy. Here's the rest of the world. This is the stock markets, lots and lots of money. $37 trillion in the stock markets, okay? Global money supply. How much money is in the whole world? Is this much, okay? And that's 36.8 trillion. Now, if you include, so this is what's called narrow money. And then if you include broad money, which includes market accounts, checking, all of this other stuff, you get 90.4 trillion. Okay, only 8% of it is actually cash. You know, but that's all the money in the world. The whole world is this many hundreds of billions. How about debt? How much debt is in the world? So, a lot more. You know, a lot more debt is in the world. This is 215 trillion debt. And it's gotten to be a lot more now, you know? This is emerging markets like third world countries. So debt is bigger. I mean, that's a lot. Each square is $100 billion. That's a lot of debt. It's a lot more than the world's money supply. How about real estate? The total value of real estate in the world. So commercial, agricultural, okay, 217 trillion total. And that's a pretty big amount of money, right? 21% is in North America, 24% is in Europe. That's a lot of money. Each square is $100 billion. Now, derivatives.
Sir, I have a question.
Yes.
It's loans? Like they include loans inside this?
Loans would not be in real estate. Loans would be in debt. Now, let's look at derivatives. Options and futures. Only options and futures. There's more money in derivatives than there is in the world by a factor of like 10. There's more money in derivatives than there are in gold, silver, everything, all real estate in the whole world, all debt in the whole world is nothing compared to the derivatives market. The derivatives market is insanely huge, 1.2 quadrillion, and I'm sure it's a lot more now. Why? How is this possible?
Because we're making value out of thin air.
Yes, that's a big part of it. And remember, we said, we're looking at Facebook now. Every contract is 100 shares of stock. What's the current price of Facebook? $358. So one options contract So one options contract is $3,580 worth of stock, right? Constance, does that make sense? One options contract is 100 shares of Facebook.
Okay, oui.
So one options contract is worth a value of $3,580, okay?
Which is 100 times more than its actual value.
Yeah, well, it has no actual value. It's just a piece of paper that's a contract. I mean, it's nothing. But it's technically, it's worth 100 shares of Facebook. Now, there are two kinds of option contracts we need. And I know this is a lot of information. We can always come back to this at other times. But we do need to understand this to understand the options market. Call and put. Call
That sounds like poker.
It sounds like down. It sounds like what?
The call thing is like a poker
Oh,
move. They're not ashamed of anything.
now in the most simple terms, this is exactly what you need to know. And this is all you need to know about a call and a put. So there are two things in options, these contracts. You can buy and sell. So you could buy or sell a call. You could buy or sell a put. I don't want to talk about that right now. I just want to talk about the difference. Let's say I'm buying. If I buy a call, now the price of Facebook is currently at $359. I think the price is going to go down to $135. Do I want a call or a put?
A put.
I want a put. I bet that the price will go down. Now I'm going to make a contract with Minsu. Minsu, you own lots and lots of Facebook stock, okay? And I'm going to make a contract with you. I will bet you that the price is going to go down to $135. Okay, let's actually make this exactly $135. That's my bet. I bet you the price is going to go down to $135. One contract, so that's 100 shares. Now, what do I have to give you today? What's the name of the cost? The cost is called the if I'm remembering that right. It's called the margin. Okay, so I have to pay. So Minsu, I want to bet you that the price is going to go down to 135. If the price goes, and we have to choose a time. So let's say I'm going to bet Minsu. I bet the price will go down to 135 in, let's say, 6 months. Now, this time thing, you could choose 1 year, 2 years, 1 month, 3 days, and there's lots of choices. But let's take a 6-month bet. Now, in order to get this bet with Minsu, I need to pay you. Okay, it costs me money to make this bet. So Minsu, I'll give you $100. Now Minsu, you don't think the price is going to go down. You think the price is going to go up. Are you happy to take my bet?
Yeah.
Yeah, of course. Great. Cool. I give you $100. The price keeps going up. Now you made $100. That's a call option. Now, if we go to the website, the CBOE website, here's the strike price.
It's a sportive bet.
Now, what you can do here are your choices. We want, for the options range, there's so options are so complicated. There's one other thing you need to know. At the money, near the money, and in the money. At the money means you're betting that the price will stay where it is. It's at this price now. If it's near the money, up or down a little, because it's near. When we say the money, we mean the price now. That's what we mean by the money. In the money, here's where you make millions. So my trade with Minsu, is it at the money, near the money, or in the money?
In the money.
Very much in the money. Now let's see how much it would really cost to make this bet. So let's change this to all instead of near the money. Now, and I want to look 6 months into the future. So how can I do that? Here on the bottom here where we can choose. So it's August, September, October, November, December, January, February. February 2022. Okay, so February 2022. That is so unrealistic. I literally can't buy a contract for 150 for 135. Right, my bet that it's going to go down this low is so unrealistic. You can't even buy it. But you can buy $150. The strike price is the price of your bet. The price you think it will go to. Now you could buy, yes, question?
Can you show us where's the $150 in Facebook now?
You mean show you this line?
Yeah.
Sure.
So who's buying and selling these contracts? I'm confused.
Everybody.
Individuals?
The whole world. Banks, hedge funds, mutual funds, individuals, rich people, everybody's buying these things. You saw that chart? The world is buying and the whole world is betting. This whole thing is gambling.
Who's putting them out? I mean, who's putting them out?
Oh, the CBOE, the Chicago Board of Options Exchange. They are, if this is Las Vegas, they're the gambling casino.
Casinos.
They're the casino.
And you don't fool the house.
And there's other casinos. There's lots of them. In fact, my teacher used to call this playing the casino. So here's 150. Now that's still a pretty key level, you know. I think Facebook stock might go down to 150. What if we think in 6 months, by February, how much would it cost? Remember, what we're buying is the value of 100 shares. The bid and the ask. How much money you are, this is the price. It's somewhere, these prices change every second, but it's somewhere between these two. Now, if you see last, that's the last price that someone paid. Nobody's buying this because nobody thinks Facebook is going down in 6 months. However, a bunch of people, nope, only one person. One person bought at 180, only one person. Now, let's talk about this one person. They bought one contract. How many shares of Facebook is one contract?
100.
100 shares of Facebook. What price did they bet Facebook will go to in 6 months?
180.
180, that's called the strike price. We're looking at calls. We're only looking at this side of the screen. They bet that the price will go down here and that they will be able to buy it. Now, on the other side of the screen is puts. These are people who are betting that the price will go down and they will sell it. Are you willing to sell Facebook stock at 180? 50 people are. Now that's 50 people, one contract per person. So it may not be 50 people, it may be one person, but it's 50 contracts. So I shouldn't say people, 50 contracts. So someone is willing to sell 50 contracts is how many shares of stock?
5,000.
Yes. Someone is willing to sell 5,000 shares of Facebook if the price goes down to 180. Why in the world would they do that? Why would they sell Facebook? And I'll tell you why. Remember when
up again.
Well, that might be part of it. But if you were going to sell Facebook, wouldn't you just sell it now? It's at $350. Why would you wait for it to go down and sell it?
When?
Well, remember, when I made a bet with Minsu, I had to pay him. That's because I bet the price would go, I bet that I could buy it. If you make a bet that you could sell it, you get paid. Okay. I bought a call with Minsu. Minsu sold a call to me. When you sell a call, you get paid. How much? The price that you would get paid is 1.17 times 100. So how much money do you make for selling this? $117 per contract. This guy sold 50, or this person sold 50. How much money did they make? 50 times 117, about?
And times 1.17.
50 times, it's 1.17 is per share. Remember, a contract is 100 shares. So you have to multiply that thing that says last by 100.
The last is just the multiplier, right?
The multiplier is always 100.
No, but I mean, last is the coefficient. What do you call it? The thing you multiply it by, right?
Last is the last price that someone paid for this.
Okay.
So you multiply 117 times 180 times 50.
Nope, 117
times 100, right?
Times
so it's
50.
117.
No, it's 1.17 times 100.
So
117.
So 117
yes,
per
times
contract
50.
times 50.
Okay.
$5,850. That's how much this person got paid. Now, if the price really does go down, they're screwed because they have to sell this and they're going to lose money because Facebook is worth a lot more money than that. But they're making a bet that it won't go down. Now, here's something really dangerous. Don't ever do this. There's two kinds of ways to make this bet: covered and naked. Now, let's say I own 100 shares of Facebook. Right now, I own that. I make this bet. Okay, so Constance, you buy a put from me. You buy a put. You think Facebook is going to go down to 180, and I sell it to you. I get 5,800 from you. Now, the price doesn't go down. Do I have to give you the money back?
Yes.
No, that was the cost of your bet.
Okay.
It costs money to bet. So you just paid $5,000 to me to make this bet. If the price does go down to 180, and Constance, we're getting to your big question. We're getting there. This is all of the road to get up to where we're trying to get. But if the price really does go down to 180,
Mhm.
now I have to sell you the stock, right? But that's cool. I have the stock. That's called covered. I'm covered. I don't want to sell it to you, but I have it. But there's something you can do, and that's why there's so much money in derivatives. You could sell it naked, which means I don't have the stock. This is what happened with AMC and with GameStop. So you had companies that were betting that the price would go down. Why were they betting the price would go down? Because they got paid to do that. They sold puts and they got millions of dollars. But if the price, or sorry, they sold calls. The people like Misha and me and whoever, we bet the price would go up. And they said, no, the price will never go up. They didn't own the stock. They did it naked. Now, if Constance, if you give me 5,800 whatever dollars, what if the price really does go down to 180? Now I have to sell you 100 shares. What if I don't have them? What do I have to do?
Buy some.
Yep. How much will that cost me?
It will cost me
How much will it cost me to buy them?
the actual, like not the moment
180,
I get my bet, but like
180 times 100.
Yeah.
$18,000. So is that a good deal for me?
No.
No, it's a terrible deal. And this is why people get destroyed, because they make a bet about stock they don't own. And that's what happened with GameStop and AMC. They made a bet that the price would go down, but the price went up and they didn't own the stock. Then on the day that the option contract was over, on February 18th, 2022, the companies, I forget the name of the mutual funds and the hedge funds that sold these calls, they had to buy the stock. They expected to buy it at nothing. But the price was now super high and they had no choice. They had to buy it. So what did they do? Anybody know the story of GameStop?
No.
What did they do? They sold more calls. Why?
To
get more
get
money.
the money.
They had to pay back these people. It's like paying off a credit card with another credit card. That's all they did. It's all gambling. Sorry?
It's like you're digging your own, like.
Of course it is. But they expect that people like Misha and David and the retail investors can never hold on. They think we're weak hands and we'll sell and then the price will go down and then they'll never have to pay us. It's all gambling. Now, to get to Constance's original question, which is, how does this help us trade stock? Remember, these are how many contracts, the interest, INT is interest, how many contracts? Somebody bought 2 contracts. Here, somebody bought 2,088 contracts that they believe the price will not go down.
Oh, this influences the W and the M's, right?
Oh, this influences the price huge, because this website we're looking at, this is the CBOE, this is the casino. This is the same website they look at on Wall Street. Everybody looks at this website. Now, 2,088, how much money is that?
Sorry, I thought puts was betting on it going down. So if there's 2,088, contracts.
2,088 contracts of however many people would be willing to sell Facebook at 160. They'd be willing to sell it at that price.
So they think it's going to go up?
They think they're not going to have to. So think of it this way. Let's say, Misha, I have a beautiful phone. Okay, it's brand new model, and you want to buy my phone. And I say, Misha, if you can get 10,000 RMB in the next week, then you can buy it. Now, I'm betting that you can't. I'm selling you an option contract. We learned about option contracts in my law class. You're muted, Constance?
I don't remember learning about options in law.
Remember the example that you want to rent an apartment, and I'm the landlord or the agent, and I say, okay, Misha, but hey, the apartments in Shanghai go very fast. They really go fast. Do you want to get it today? And you say, no, I need to talk to my roommates. I need to think about it. And so you say, David, can you keep this offer open until next week? And I say, well, if you pay me a deposit, then I'll keep the offer open. Does that make sense?
Yeah. I get how like futures work. I just don't get this specific one. The 2,000 people are betting that it will.
Well, it's 2,088 contracts. It might be one person. I don't know how many people it is.
2,088 people are willing, so they get money for making this bet.
Yes, they're getting a deposit. They're getting paid. That's why they're making this bet.
Okay,
they don't really want to sell it at 160.
Right.
Now you see these numbers. So 2,088. That's a lot of money. 2,088 contracts. That's 2,088 multiplied by 100. That's 208,800 shares of Facebook. Each share right now is $350. That's $73 million right there. Now, let's look at something that's closer to the price now and look at the open interest to find floors and ceilings. Let's look at calls first. Calls are people who think the price will go up. How many? Let's find the one with the most. Here's 364, 386, 386, 382. Okay, so the highest, 425. So the most number of people think Facebook will go to $395 in 6 months. Oh, no, sorry, $400. $400 in 6 months. If you want to buy this option contract, you want the option, just like the option to rent an apartment, you want the option to buy 100 shares of Facebook at $400. You want that option. How much will it cost you? For one option contract, how much will you have to pay?
$40,000?
No. This number is here is the key. What does 16.69 represent?
This time 100.
Yes. Yes. So that number times 100, $1,669. That is the cost of one option contract to buy 100 shares of Facebook at $400 in 6 months. That make sense?
You still have to buy them, right? This doesn't.
Oh yeah.
Okay.
Oh yeah. You still have to have the money to buy the shares at that price. But here's the key. Nobody's actually buying the shares.
So that's where you can go.
They're buying and selling the contracts.
Okay.
If we get to next February, like February 1st, let's say the price is up to $500 now. February 1st, the price is up to $500. Now, is this a valuable option contract? It gives you the right to buy 100 shares at 400. Is that valuable?
Sorry, could you repeat that?
Sure. So this, remember, is for February 18th. That's when this is ending. This contract gives you the right to buy 100 shares of Facebook stock for $400 per share on February 18th. Now, what if on February 1st, Facebook price is $500 and it looks great? It looks like it's going to keep going up. Then is this contract valuable?
Yes, because
yes. Why?
Because you still have the difference of 100.
Absolutely. You could buy the Facebook for 400 and immediately sell it for the market price, which is 500. So it doesn't even matter. Borrow the money. Who cares? Get the money somehow. You know, it's a great deal because you buy it at 400, immediately sell it at 500 in a second, turn around and make that profit. That's amazing. So if the price of Facebook is going up to 500, people are going to buy and sell this option contract. Therefore, the most expensive prices, look at some of these prices. Look at this one over here, like 77. That's Facebook at 310. That's like the price now. That's just a little less than the price now. Why is this contract valuable right now?
Because nobody thinks the price is going to stay the same.
Well, would you today be willing to buy Facebook at 310? Today's price of Facebook is 358. Would you be willing to buy it for 310 right now?
Yes.
Minsu, would you be willing to buy it for 310?
Yeah, I think so.
Why?
Because it's lower than the price now.
Exactly. You could buy it from me for 310 right now and sell it right now for 358. You made $40. That's in the money. It's already worth money. How much does it cost to do this? To buy 100 shares, to have the option to buy 100 shares at this price. How much would that cost?
Oh, it would be like
770, 100.
bucks. Yeah.
$7,730.
Right.
The market works to make sure these, look, if the price wasn't a good price, you just buy it. If the price was super cheap, you just go and buy it right now and sell it and make money. So that cost is always going to kind of match. Here's where people make millions. If you think the price is going to go to $700 in 6 months, let's say you know something. Okay, Minsu, you know all about whatever cryptocurrency, and you believe that Facebook is going to take over Bitcoin and whatever. You think it's going to go to $700. How much would it cost you to buy this contract? To buy a contract that gives you the right to buy 100 shares at 700.
7,000.
Oh no. How do you figure out the cost of this?
0.30, 0.7,
0.37.
0.37 times 100.
Yes. So how much?
37.
Yes. It would cost you $37. Now, hey, that's not that expensive. You spend $37. What if the price by February went to $1,000 for Facebook? You would have made an unbelievable amount of money. Now, these are the prices for 6 months away. As you get closer, let's look at the October prices. Look at how low these are. 0.06, 0.1. This is where people are really gambling. You know, 0.1, that's $10. It'll cost you $10 to have the option, not the requirement, you don't have to, but the option to buy all of this Facebook stock at the price of $5.50. Now, if you think Facebook is going to crush it and go super high, super fast, who has the money to buy 1,000? I don't have the money to buy 1,000 shares of Facebook. 1,000 shares of Facebook would cost 1,000 shares of Facebook would cost $350,000. Okay? If you want to buy them today, 1,000 shares of Facebook would cost $350,000. Constance, do you have $350,000? How much would it cost, Constance, to buy an option that would give you the right to buy 1,000 shares of Facebook at this strike price?
$100.
Yep. And that's why everyone's gambling. You could spend $100 today. And how much money are you really betting? $350,000. And this is Facebook. You want to talk about any of the other stocks in the world? Not every stock will let you do the options market, but many, many will. Now, let's talk about open interest. Look at the number of contracts. The number of people who are betting. We're talking about October 2021. Oh, yeah.
Sir, I'm sorry, I need to go to work. Otherwise,
No problem. We're almost done for today. We focused on this, but I'll show one last thing at the end. So if you want to watch the last like 15 minutes of the video, you can do that later. Okay, bye. So look at right here, 5,919 contracts at this price. A lot of people. So now here's this kind of, and it's you know, sad Constance had to leave. This was really her main question. Constance's question is, how does this help us? We're not really betting right now. So how does this help us to make our trades? Let's talk about this price here. $390 by October 15. If you wanted to take this bet, do you think that price is going to go above or below $390?
Above.
Above, correct. Why?
Because there are like almost 6,000 people, 6,000 contracts betting on going up.
What are they willing to do at this price?
Be willing to buy it when it's higher than.
They're willing to buy it at 390. That means they think 390 will be a good price. They wouldn't be willing to buy it if they thought it'd be a bad price. So what does this tell us? When now it really goes back to our charts. When we're drawing our lines, let's look at, you know, a daily chart again. When we're drawing our lines for Facebook, what does this tell us? It tells us that the level 390 that actually might be a floor. Because the people who are buying, I mean, that's a lot of contracts, you know, 5,000, that's almost 6,000 contracts. Each contract is 100 shares of Facebook. So each contract is like $3,000. So
this is like the, what's it called? This is the public opinion, basically. How much it's going to cost at this date, right? For the people who buy up. Yes.
So what we're doing is we're not analyzing the prices and drawing lines at the prices. We're analyzing the world. And we're looking at how much interest, INT, how much interest is there? If there's so much interest buying Facebook at this price, that's really valuable information. What it tells us is this is what people expect to happen. They expect that before October 15th, let's say it's around October 15th, October, around here. Before that time, people are expecting the price to do this. You know, and it'll go up and whatever, and go down and up, but that at this price, because look, people are not trying to make millions of dollars on these trades. They're trying to make some money. They expect that this pink line at 390 is going to become a floor. And that at this point, when the option is expired, when it's time to make your decision, that they could exercise the option, they could buy the 100 shares and immediately sell them. So they buy the 100 shares at whatever, 403, and sell them at 390, and they just made $1,000. That's what they're betting. So it's really valuable to be able to understand these charts. Let's see, is that the highest interest? Ooh, there's a lot of interest at this price.
What about like the people who buy like 560, those calls? So is it kind of like insurance that you buy it at like $60, and then it's probably
Oh,
not going to
not
go that
60.
high, but if it
That's
does,
six.
you're a
That's
millionaire.
$6.
Yeah, $6, not even 60.
Yeah. So for $6, you just guarantee if anything goes crazy and Facebook goes super up, I'm going to make money. Now, here's what you might do if you were a more advanced trader. You would have two bets at the same time. One, you really think Facebook is going to go down. But like you said, as insurance, you buy one of these just in case it goes up. You can do it in the other direction too, right? Now, these are going to be super expensive. So think of like 160. There's actually some interest here. 160 right now is a fantastic price for Facebook, right? That's way below the market price. Market price is 350. So this gives you the right to buy 100 shares at $160. That's a great price, of course. But how much does it cost to get this contract?
It's 20,000.
$20,000.
What about
And
165? Why is it 0?
sorry?
Why is it 0 for 165? Just the next one.
165? Why, there's 7 people interested. Oh, nobody bought it recently.
Oh, okay.
That's all it is.
All right.
Sometimes you'll see different stocks. It's not always a $5 difference. Sometimes it's a $10 difference. Sometimes it's a $20 difference. This difference on Facebook is $5, which is pretty small because a lot of people are interested in buying and selling and betting on Facebook. Other stocks that are less popular would not have $5 things. Let's look at, AMC. I don't know what AMC would be. So like, what's the current price of AMC? Okay, current price is $30.40. Let's see what we get for AMC. Let's look at, August is much too soon, I think. Let's look at December. So couple months away. AMC at $1. Is that a good price to buy AMC? Yes, a fantastic price. Of course it's a great price. How much will it cost you to get that contract?
$3,600.
Yeah, $3,600. So not many people are interested, but some. Let's see what people are most interested in. 1,400, 3,004, 54, 57. Anything bigger than that? 8,000, 17,000. All right, here we are. This is a lot of contracts of people who believe. What do they believe? Tell me what they believe.
That AMC is going to go up to $145 per share.
Above. It's going to go above 145 by December 17th. And then they could buy it and immediately sell it for a profit. How much does it cost to take this bet for 100 shares?
$154.
$154. Now, what if you wanted to take a sort of a crazy bet? Can we take any crazy bets? No. AMC is totally bought up. Everything's expensive. There's no, I wouldn't buy these options because it's all much too expensive. Let's look at something else. Let's look at.
So wait, would you expect a price drop or rise at this date, December 17th then?
AMC is such a weird stock that it's hard to say. Obviously, a lot of people think it's going to go to at least $100, above 100. A lot of people think that. What about the other side for people selling it? People would be willing to sell. A lot of people would be willing to sell it at $1. Well, that's because they're getting paid, but 11,000. So on the other side, the people who are betting it's going down, they're betting it's going down below 15.
Mm-hmm.
So you have this huge range here, but it depends if you're bullish or bearish on AMC.
Which
Let's try something a little less crazy.
Options for? Is it for every single day? You can set up like December 15th, 16th,
No,
17th.
no. The casino has their own dates.
Okay.
So here are your choices. You go to expiration, you have choices, but it's
it's
one
monthly.
day per month. The date is in the middle of the month, but you can do all the way out to like January 2023. That's where the money is. So like I bought an option contract a while ago for a marijuana stock. Let me see which one.
I think you mentioned a while ago. Oh, in our previous club.
Kronos. And Kronos is doing terribly. So, but look, oh my God, look at how important this level is. Now that we're talking about these support and resistance levels, look at how important this current price is. I mean, it went down and then it went down to exactly this price all the way up. And it just happened coincidentally to go only exactly back to this price and then up and now back to the price again, then again, then again. That's 5 touches. I mean, that is such an important price then. Now, what's going to happen next would be a very important thing. But let's look at Kronos here. Let's look far out now. Let's go to January 2023. This is called a chain. It's called the options chain. Kronos at $3. No, that's too expensive. Here, 0.3. Kronos at $32. That's it? I want more. Okay, no, that's it. That's the cheapest I can get. So for $30, I could make a bet about 100 shares of Kronos stock if it'll go above 32. Could it? Sure, maybe. I mean, it's not likely. Its all-time high price was $15.90. But, you know, is that its all-time high? Oh, no, it was not. Ooh, hello. Hello, $26. What was the all-time price on Kronos? Yeah, that's the all-time high. But look, I mean, the all-time high was $26. If we want to bet that it's, so of course, taking these bets, the farther out in time, the more expensive the price. Let's look at $32 in October. How much would that be? Can't even do it. $21 is $2, a $2 bet. Now, is that a good bet? 787 people think so. You know, for $2, hey, do you have $10 to waste today? You could buy an option contract for 500 shares of Kronos. What else could you buy for $10? 2 Starbucks coffees? I mean, if you want to gamble, this is gambling. You know, I don't recommend it. You'll lose your money. It's not a good deal. You have to know stuff. You have to know all of the things we're talking about in order to make money doing this. But hey, if you really know something and you believe that marijuana stocks are going to go, 21's not that high, considering it used to be its all-time high was above that. Imagine if you had 500 shares. And here's what a lot of people do. They don't just buy for $2. They don't buy 10 contracts. They buy like 100 contracts. $20. So you're throwing $200 rather. You're throwing like $200 at this. But if you win, you're winning, you know, tens of thousands of dollars. You're winning a lot of money. But nobody really thinks the price is going to go that high. That's why these prices are so cheap. When the prices are expensive, like 4.3, that's expensive because that's valuable. Mm-hmm. It's probably not going to go to $3. You could sell it right now and make a profit. So of course it costs $430 to do that. Oh, sorry, $4,300.
Put options again.
Put options are the same idea, except instead of buying it, we're talking about selling it. So you'd be selling it at this price.
Money from the casino?
No, the buyer of the option. So it's no different than me saying, I'll rent you my apartment if you give me a deposit today. I get that money, the deposit, but if you want, I have to rent you the apartment. So here, if let's say we do Kronos at $21, How much money will I get to sell you this bet?
$1,300.
Yeah, $1,385. But what is my risk?
The risk is
What
the
happens
share
if,
of Chronos
what happens if
going.
Chronos really does go to $25?
See,
What
this is
do
what
I,
I'm getting. If it
what
goes
do
up to
I,
$25, you have to buy it at.
well, I have to sell it to you
Mhm.
at 21 per share.
Oh, I see. Okay.
So I have to sell it to you at that price. Now, if I own it, maybe that's cool. Now here's I'll leave you with this because we are over time, but here's a little trick that more advanced traders use. Let's say that I have 200 shares of Chronos right now. I bought them a long time ago. I bought them when the price was over here, 22 cents. So I have, 1,000 shares of Chronos or whatever, and I want to sell them. Here's what I can do. Instead of just selling them today, I'm comfortable selling them at today's price. I'm comfortable selling them at this price. Here's what I can do. So the price is now about $7. Instead of selling them today, I'm going to create a put contract that says if the price hits 7, I'll sell. Was I happy to sell at 7 anyway?
Yeah.
Yeah, that's a cool price for
so
me. And what do I also get?
And plus the money you made from that contract.
$64.
Oh, wow. Okay.
What if I want to sell it at 8? I want to sell it at 8 anyway. I would love to sell it at 8. Now, instead of just selling it on the market, people who understand options trading, you create a put contract. And now I'm going to get $122 and I sold it at a price where I'm cool. That's why you have so much interest from people here. You have a lot of people who are totally fine to sell it. Hey, you want me to sell it at $12? Cool. I'll sell it at $12 and I'll take your $490. I'm doing great. And then what if it didn't go up to 12? Do I have to sell it?
No.
No, because it didn't go up to 12. I said I would sell it at 12. If it went to 11, what do I get?
If it goes to 11, you get plus $4 in every share that you
Yep.
sell.
4.9.
And
So
4.9.
wait, not on shares I sell. I made a contract with you that said, if the price goes to $12 on this day, before this day, October 15th, if the price goes to $12, I will sell 100 shares to you at 12. That was the contract I made with you.
Mm-hmm.
Does that make sense?
Yes.
How much money did it cost you to make that contract with me?
$490.
Correct. Now, if on this day, October 15th, the price is at $11, do I need to sell it to you?
Could you repeat that? If on that day.
The price is at $11. What was my contract?
Have to sell.
My contract was I will sell it at 12.
Only at 12.
Only. 12, or if the price goes over 12, I'll sell it at 12. What are you betting?
I just puts or like the opposite of calls. Do they work differently?
No, they work the same. The difference is one is buying, one is selling. If I buy a call at $12, I want to buy this stock at $12. I think 12 is a good price because I think it's going to go higher. If I buy a put at $12, I want to sell at this price because I think the price is going to go lower.
Okay.
Now that's me, David. I'm the customer. I'm buying a call or I'm buying a put. If I buy a call, it's because I think the price is going up. If I buy a put, it's because I think the price is going down. But remember, I'm the customer. I'm buying a call. I'm buying a put. On the other side is the person who's selling it. Now, if I'm selling a put, I'm willing to sell you my stock at $12 if the price goes above that on this date. If the price doesn't go above that, if the price goes to $11.99, I don't have to sell it to you. And I keep your deposit of $490. And that's what 857 people are trying to do.
But you should really only be doing, you mentioned puts when you have the shares, right?
Oh God, yes. Oh my God, yes. Because what if I made this deal with you? I'll sell it at $12 and I don't own the shares. And all of a sudden, the United States government says marijuana is legal and it's everywhere and the price goes up to $100. I have to sell it to you at 12 and I don't own it. So what do I have to do? I have to go buy 100 shares at $100 each. That's $10,000. And then I have to sell them to you for $12 each. So you never want to do this unless you own the shares. It's just, this is a really good way to sell your shares because you get to choose the price you would sell them at and you get paid to do this. So it's a really good way to sell your shares. If there's a share of stock that you are willing, you have to be willing to sell it though. Because if it did hit $12 automatically, I mean, it's not like you call me, it goes through the computer. If it hits $12, it's sold. So you have to be willing to actually sell. But if you find a good price that you say like, hey, I don't think it's going to 12, and if it does, I'd be happy to sell. Well, then options contracts are a great way to sell.
So if it goes below that, you can still sell at 12, right?
I could do whatever I want. It belongs to me. If the price goes to $7, I can keep it. I can give it away. I can sell it. I can do whatever I want. If it goes to 8, it's mine. 9, it's mine. 10, it's mine. It's only if it goes above 12 that you could choose to exercise the option and you could choose to buy the shares.
Okay. Got it.
Okay, it's a lot about options. But the point of it really is to look at this interest over here and to see, because these numbers, when they're really high, like, 1836, that tells us a lot of people think $8 is a good price. And what that means is we now have more information here. If a lot of people think $8 is a good price, maybe there's a chance this thing is going back up. It's not our only way of knowing. Next week we'll talk about the things I was going to do this week, more support and resistance type stuff. Next week we'll use the SMA and EMA, which kind of looks like these levels, right? These lines that go up and down. They're also support and resistance. We're still studying support and resistance, and so it's okay that we're doing options because that's still giving us support and resistance. And remember, by support and resistance, I mean floors and ceilings. I mean these lines. Nothing happens in trading without these lines, okay? These lines that you're drawing. So I would say for homework, just pick another stock. Do the lines, look for the confirmed W's and M's.
You were saying for weekly you use the what's the name? For the weekly you use the ray, and for daily
I use lines for everything.
Oh.
I stopped doing, even for like weekly, if this was my weekly high, I just have like weekly green SNR. And I have a different color set for monthly, and I have a different color set for 4 hour, but I'm using lines for all of them now.
Okay.
And the reason is, let's say that we're looking on the 2 hour chart. and I see that, this is a W right here, kind of. It's not a great W, but let's say I think this level is important. So I want to mark this level. If I have a line, then I can look backwards in time and see, is it important? Are there other times? Like, no, it's actually not super important. It went through it, it went below it, it's not really an important line. An important line is where it gets touched all the time. So I might say, no, looking over here, I thought it was important, but actually it's probably not important. But maybe this is an important line over here. And then I can look backwards and see, is this a place where the price keeps touching it? Well, kind of, here, kind of. And then here it went through and now it became a floor. So maybe here it touched it again, here it touched it again. Yeah, okay, I would say this line is probably an important line. Not like, oh yeah, definitely an important line. It went right through it and played in this area. It played in this area. I mean, this is how you know if the line's important. There isn't really a science to this. There's steps and tools and stuff, but you yourself have to feel it and go back and be able to say, does this line seem important to me? And I think it does, because that's how you tell. The price keeps sort of dancing around this line. It keeps touching it. It's obviously an important line. But the only way I knew that is because I didn't make a ray. I was wrong about that. It should have been a line. Okay, cool. Let's stop there for today, and I will see you guys next week.
All right, thank you.
Bye.
See you next week.